Let's talk first about the stimulus side of things, because we saw these aggressive moves from the Fed, the ECB, and if you look at the PBOC and what policymakers have done in China, it's looking modest at best. Why do you think that is?
Yvonne, yes, very different approaches between the U.S. and China when it comes to fighting the economic fallout of the coronavirus. You have China's central bank injecting money into the financial system, but it's held off from those steep interest rate cuts. And on the fiscal side, they've also been accelerating spending on infrastructure, lowering taxes, but nowhere close to the $570 billion bazooka stimulus that China unleashed during the financial crisis. And yes, a stark contrast to the U.S., where the central bank cut the Fed funds rate by 150 basis points this month, and the administration is now pushing for that $1.2 trillion fiscal stimulus. The reason why you're seeing such a cautious approach from China is because of ongoing concerns about debt, given that China's debt load is almost 3 times the size of its economy. China could also be holding fire until the second quarter, when falling global demand really starts to hit China. But that being said, this disciplined approach is being tested every day. Economists are continuing to download their outlook, now downgrading that China's economy is going to contract by 6% from a year earlier. So this doesn't bode well for global recovery, given that China now accounts for 30% of global growth.